Welcome, everybody, to the 2026 Market Outlook with Intention Financial Partners. We are so thankful with our panel that we have today and thankful for you as clients and the partnerships that we have worked through in the last year. Look forward to sharing a look back and then also a look forward. Today, my name is Jacob Schatz. I'm a partner with the firm, and I am joined with two experts in Pat Morris. He is our investment manager. He's a CFA within our firm. And then Andrew Abel, who is on the our investment committee and handles a lot of the operations and due diligence on the trading side. So before we jump into a look forward, we're going to take a look back from our 2025 outlook. And if you recall, historically, we've done themes. And these themes, sometimes we see them materialize, sometimes we see them not materialize, but they are shaping the thesis behind our investment construction. So the first one last year was fragility. We saw valuations on the US side higher, so it reaffirmed our international stance. We saw some concentration within large cap in certain spaces. And then we also saw inflation that was relatively high. We weren't sure if we'd see reinflation. We didn't know what rates would do, but it led to portfolio construction just with those things in mind. Durability was intentionality and focusing on making sure that for any risk that we take, that we are getting compensated in return. So when we look at each of the asset classes, we want to make sure that we have durable portfolios that can hold up well during various times. And if you look back a year ago, I think ironically we did one of these outlooks, and either the day of or the day before was when the tariffs got announced. And yeah, talk about having, fragility and durability in portfolios because we did see resiliency through that period, but it was unexpected. We weren't necessarily predicting that, but there was going to be things, and that we saw that last year that happened throughout the year that reinforced that stance of durability. And then alpha, that continues to be, I would say, transformative into new things going on, but the concentration within certain sectors on certain stocks that were driving a lot of the performance. And how can we make sure that we don't have all of our eggs in one basket, but utilizing active managers in certain spaces to drive alpha? And we really saw that last year in the international and emerging market space. So I'm going to turn it over to Pat as he looks then into our new themes and going forward.
Thanks, Jacob. Yeah, as Jacob said, every year we have three themes. This year they are AI playbook, navigating valuation, and noise resistance. So the first one, and the one we'll probably spend the lion's share of the time on, is AI playbook. So you can't go anywhere without people talking about AI, whether it's at your job, whether it's going to replace your job, whether you're booking a trip, whether the video that you're looking at on social media is AI generated, whether the sports highlights are AI. So it's a lot. It's a lot in society, and it's a lot in the portfolios. So, and we're going to talk about that, about how we are offensive or defensive with AI in our portfolio, where it fits in our portfolio, how much it is in our portfolio, stuff like that. Second is navigating valuation. Now, this seems like to me almost a recurring theme. We've been at very elevated valuations in the S&P 500 now for 3 years, or this will be almost the fourth year. So just a very interesting, how are we going to go about that? Where do we see other valuations increasing, and how to kind of navigate where we're going to invest? And then the last one is noise resistance. 2025, we had a lot thrown at us between, like Jacob was talking about, we had Liberation Day, we had the government shutdown, we had policy changes that were probably the most comprehensive we've seen since World War II. I mean, I think back that it's only been a year, and it hasn't even been a year since Liberation Day. It seems so long ago, but those are the kind of the themes. So but before we do that, we look at ourselves. I don't look at myself as an economist. We're allocators, we're investors. But to say that we don't look at the economy is foolish, because it's obviously a very important part of investing. And we're lucky enough that we partner with Fiducian, and we have you know the means to have some great economists and stuff that we can look at like that. And here's one of the things that we looked at. And if you joined us last year, you remember this chart, or maybe you don't. But it's by a firm called Strategis, and it's called their diffusion index. So what they do is they take 14 of what they think are the most important economic variables or components, and they rank them either an asset, meaning it's good, a liability, meaning it's not so good, or neutral, meaning it's in between. So last year at this time, I went back and looked, there were 4 assets, 1 liability, and everything else was neutral. Now, obviously, there's varying degrees within each category, but a couple I want to spend time on here and talk about that I found interesting was the first was consumer spending on the asset side. It's a positive, and the United States is a consumer spending is a high portion of their GDP. It's the highest portion of the GDP, and 10%, the top 10% of the people are doing 50% of the spending. So they're the ones that are driving consumer spending, which obviously helps with earnings, and earnings help with higher markets. Now, that's not to say the 90% that haven't that aren't in the 10%. It was almost kind of like a K economy. If you look, the line going up is obviously the 10%. The line going downward is 90%. That's not to say they've been left behind, but they might not have as many means to financial assets as the top 10% who have seen, great growth over the last 3, 5, and 10 years. But those people are seeing, their milk prices go up, their car prices go up, their home prices go up. So it's something that kind of has to be looked at. And then on the negative side, or on the liability side, is government deficit. Now, debt as a percent of GDP is now over 100%. And one of the things that I find interesting, I'm not much of a political person, but one of the things that came up with this was, the aspect of affordability. And that seems to be a lightning rod for the 2026 elections. Like the mayoral race in New York, even the current administration talked about capping credit card rates, the outlawing or the restricting of financial firms from buying individual housing, all this so that everybody's talking about affordability. But if they're giving you affordability on one side, chances are that there's going to be something on the other side that will increase the deficit. So that's something that we look at, obviously, because that could be inflationary. It could weaken the U.S. dollar, which is one of the reasons why we're diversified and we have foreign investments, because those would benefit from obviously a weak U.S. dollar as we saw last year. So let's go through some of our capital market assumptions. And most of these are moderating because of the year we had last year. So we'll start off with fixed income. So as you can see, the 10-year, and what we do is we use these to build our models. They're 10-year looking, they're 10-year forward looking. So nothing really short term, because we don't want to be like trying to chasing returns. So these are something that are built in empirical formulas. So we've seen, U.S. bonds, TIPS, dynamic bonds, they're less than they were last year. They're still at a decent rate. And then muni bonds, same thing, a little bit less because of the year we had last year. We had 6, 7, 8% bond returns, which is really, a very good year for bonds.
And sorry, Pat, I'm interrupting here unexpectedly,
Sure.
but going back to that last slide with fixed income, red doesn't necessarily translate to bad. Sometimes we see that red return and we're like, oh, we see a bunch of red across fixed income, but as you had mentioned, it's really looking at the returns that we had that were higher than, anticipated, and what do we see over the next 10 years. So still, your perspective will be helpful here, but if we look at U.S. bonds, TIPS, dynamics on those 2026, Does feel really good, right?
Yeah. Oh, yeah. I mean, well, and that's a great point. Here's the slide. So you're right. The negative seems like it's that we had negative returns. It was just meaning the returns that we expected in 26, that we're expecting in 26, or the 10-year return for 26 going forward is less than it was in 25, and that's because you've already had one good year. I mean, so and in retrospect, if you look, if this chart, the higher it is, the cheaper it is relative to history. So almost the higher it is, the better it is. So as you can see, for example, if you look at just to make it easy, look at cash. That was 84% percentile rank, 100 obviously being the best last year. Going into last year, going into this year, it's at 76%. So less than it was last year, but still on a historic basis or a 20-year basis, it's looking very attractive. And that's across most of the bonds. If you'll see, look at the third column is the long term, fourth is the aggregate, even the tips. And at the bottom, you see what the yield is, right? So the tip yield is 4%. The aggregate yield is 4.3%. The cash, this is a little bit dated, so cash is 3.9. That's more around 3.4 now. But still, in the 20 years, I mean, it's kind of funny the memory we have, right? Compared to last year, you're like, well, this might not be as good. Well, think back to 2020, 2019, 2018, when there was no bond yield at all. You were getting 1% or you weren't getting 1% on your cash. So, but the other thing I want to kind of point out is to the far right is that historically low, and that's the spread. Now, what we mean by spread is what you get paid above and beyond what the government bond or the risk-free bond is for that product. So, like the high yield spread is 281 basis points. Like that's historically low. You'd think of something in the 400s. Same thing with the government investment grade spread is 78. So these are at a 20-year kind of low. Doesn't mean that we're not going to allocate to them. Just means that we're going to have a more modest allocation because we don't foresee greater outperformance from those instruments. And same thing on the market forecast for equities. You're looking forward. You look. A negative 4% or negative 0.4 is just the increase because of the year we had last year. Going forward, the return expectation for the U.S. all cap is low, and it's not much more than it is for bonds, and that's something we'll speak about a little bit later. But that U.S. all cap is pretty much driven by the S&P 500 and the outperformance it's had there. As you can see, there's been an increase in international developed and emerging markets. That's because of growing earnings and then the tailwind of the weaker U.S. dollar. So now this one is flipped. The valuation, the higher the number, the more fully valued it is, and then the less, the elevated it is, and the less expectations, I guess you could say, you have. And it almost doesn't matter if you look at it from price to earnings, price to book, price to cash flow, price to sales. Those are the four first columns. The S&P 500, which is the black dot, extremely high valuations, right? But that's been that way for 3 years. So that's not to say we're going to rush out of that asset class, but we're just kind of putting it in context. But even if you look, the developed market, international developed markets and the emerging markets, same thing. They're all at the top. Where you can see some relative valuation, and Andrew will touch on this a little bit later, is the Russell 2000. They're slightly elevated, but obviously not up near the 100% mark like the other ones. So speaking of that, I'm going to turn it over to Andrew, and he's going to kind of dive deep into the three that we talked about, but starting with the AI playbook.
Yeah, thanks, Pat. What I want to do first here is just give a quick refresher of those three key themes. So first, AI playbook, which is what I'll go through most today. Like Pat said, you can't really go anywhere without talking about AI at this point. whether it's related to your job, investments, so many other things in life. But it's important to start with the facts, and then we can look at different offensive and defensive strategies regarding that. Number two, navigating valuation. Like Pat said, equity valuations are fairly robust right now, meaning high. So what do we do about it, and how do we take advantage of those opportunities that this creates? Third, noise resistance. Despite all this economic noise that we've had in the last year, we've had a federal government shutdown, some of the largest shifts in economic and fiscal policy since World War II, which Pat mentioned. We're still seeing unemployment remaining low and GDP continues to grow. So setting up a good foundation for us for opportunity going forward. So first question that I'm sure a lot of you have been thinking about is AI an investment bubble? First things first, just want to say there's a lot of incredible things that have come out of AI, both positive and negative so far. And for those that truly believe that AI is life-changing or revolutionary, you also need to understand that this kind of change could potentially lead to a bubble of some sort and produce risk in markets. So to answer your question, unfortunately, there really isn't a crystal clear answer for this, and no one really knows if it's a bubble at this point. But what we can do is compare it to past events. So what I want to do is take a look at the tech bubble, for example. Tech bubble is a lot more speculative compared to AI at this time. So companies during the tech bubble, they were investing without the benefit of accruing earnings or cash flow. Now, if we talk about AI, let's look at NVIDIA as an example, and some of these other large companies. They're making a lot of money and they continue to beat expectations each quarter. And what these companies are doing, they're largely investing in AI through existing cash flow rather than debt. So we'll see if this continues into 2026 or if they start to leverage debt to continue to invest. But it's also important, there's always extremes. And in the AI case, we can consider startups with that as an example. In any cycle, there's going to be extremes. So it's important for investors to understand that some companies will stay disciplined when it comes to AI and others will stretch too far. So the ultimate lesson here that we want our clients and investors to stay committed toward risk management and to not lose sight of the principles of long-term diversified investing. So the other thing that a lot of clients at this point are reaching out about is wanting to invest in AI. It's the big topic right now, as everybody knows. But the first answer here is that everyone's pretty much already there for the most part. So what this slide is showing us is if you own the S&P 500, you're already getting exposure to AI. So almost 40% of the S&P 500 index is exposed to AI, whether that's directly or indirectly. So like I said, most people already have that exposure. So Russell 3000, we're around 34%, and then global stocks are around 26 to 27%. What this is showing us is the kind of optimism that markets have toward the revolutionary changes that AI could potentially make. Now I want to jump over to the offensive side regarding AI, and how I want to do that is dig into small caps a little bit more. So what this graph is showing us is quarterly year-over-year earnings per share growth of large caps versus small caps. Large cap, you'll see, is the dark blue line, and small caps is going to be that lighter blue line. So the expected earnings growth for small caps in 2026 is roughly 25% compared to large caps around 17. What this is saying, in other words, is that smaller companies may benefit as AI helps improve efficiency and margins across the businesses they serve. Now to this next slide, this is also regarding some small caps as well. What this is showing, and I know Pat also mentioned this earlier, so the Russell 2000 has been around 7% of the Russell 3000 in previous years, but now we're sitting around 4% of the Russell 3000. So it has gone down a little bit, but like we mentioned on that previous slide, there are more attractive valuations and productivity gains for small caps given their expected earnings per share growth. So good things to look forward to for small caps here. Now shifting over to defense, as an investor, it's important to think about the ways that we can be defensive toward AI. It's such a big topic right now. So this graph is a little bit confusing to understand when you first look at it. So what I'm going to do is break it into chunks. So starting on that right side, top right, if you're overweight the top 10 companies in the S&P 500 and those top 10 companies outperform, you're better off. However, if you look at the bottom right, which is that light blue line, if you're overweight the top 10, but the top 10 underperforms, the slope of that line is going to be much different. And this scenario is more likely to hurt you. So left side, we're looking at underweight. So if you're underweight the top 10 companies and those top 10 underperform, you'd be doing relatively well from a performance perspective. However, if you're underweight the top 10 and the top 10 outperforms, you'd be trailing a little bit. So a lot of different factors here on this slide, but what we want you to take from this is that it demonstrates the risk return trade-off between the benefit of being right and the cost of being wrong. And it also emphasizes the importance of long-term diversified portfolios. Last slide here that I want to cover, it's showing us the share of individual S&P 500 companies with sustained high sales growth from 1985 to the present. More specifically, what it's showing us is how difficult it is for a company to keep high sales going year after year. And it's important for investors just to understand that markets aren't linear, and what has happened in the past isn't always destined to be repeated in the future. So with that, I'm going to pass it back to Pat. He's going to run through our 2026 allocation updates.
Great. Thanks, Andrew. Yeah, some interesting stuff there. So let's look at our overall posture. And, we sent out an email back in January about some of the changes that we made to the portfolio, and I'll go over some of them here. But the first thing is we think it's not time to reach. First one, few fat pitches. There's no easy money. Not that there usually ever is, but at this point, it seems like with the valuations as high as they are, and it's while there's opportunities, like we said in small cap, it's a kind of a fully valuation market. So, and there's relative risks influenced by external factors. Obviously, the geopolitical risks are still out there. The kind of manipulation of the Fed by the administration, or I don't know, manipulation, but kind of like the influencing of the Fed by the administration, something that we haven't seen before. So there's those factors are out there. And then the absolute risk, just on a basis of when the market has been up and up and up, that the full valuations make it slightly less attractive entry point. So for the portfolios, what did we do? Well, it was a modest increase to non-US equities and small caps, depending on which portfolio. So, for example, our most aggressive portfolio, we increased small caps and we increased non-US equities and decreased slightly the large cap. In the moderate aggressive and moderate portfolios, we decreased the large cap and added small amounts to U.S. bonds. And the prioritization of those intermediate investment grade fixed income bonds is over the high yield and long bonds. And we did that because on a risk adjusted basis, like we said, the difference between large cap expected return and bonds, the risk return trade-off for now favored us making that slight adjustment down to more fixed income. Now, that being said, we monitor these portfolios, we monitor our models, and even though the 10-year numbers come out once a year, they're run, or we present them once a year, they're run all the time by our research partners, Fiducian, and if things change, we will, we look at this as an investment committee on a monthly basis, and we'll make changes if so needed. It's not once a year, set it and forget it. We're constantly looking at this. One of the things we didn't dive too much into today is alternatives. And basically, when I'm talking alternatives in this sense, there's two types of alternatives, but the one I'm going to refer to is kind of the private equity, private markets. So illiquid, and it's not for everyone. So it's a very long-term, could be offer opportunities, but there is an illiquidity to it. So The reason I'm bringing it up, in August of 2025, President Trump signed into law that you can allow for private equities into 401ks. So for people that are at the long spectrum looking, there could be an allocation to 401ks for private equity could make sense, and it's something that we'll continue to monitor. And I know that our Fiducian has some products that have that if that's an allocation we want to go to, or on a case-by-case basis. And then lastly, as Andrew pointed out very well, the AI playbook. We're starting with the facts. You already have exposure to AI. The market isn't missing that. Like 38%, all the big companies invest in AI. But there's a thoughtful way of how to get offensive with it, right? Like we said, small caps, where they're not inventing AI, or they're not inventing AI, but they're using AI to make themselves better and to make their productivity better. Or data centers who are on the fringes of AI, or even somebody like China who is kind of behind but catching up on AI, and that could generate better returns in emerging markets. And then discipline, the defense means maintaining discipline. So knowing where we stand on AI, knowing what percentage of the portfolio that we have and how it's diversified will kind of keep in mind how much AI we have in the portfolio at any time. So I'm going to turn it over to Jacob here to wrap things up.
Yeah, thank you so much for that content and dialogue. You two add a great wealth of expertise in that area, and I appreciate all the work that you do for our clients on behalf of our firm. And thank you again for tuning into this. I appreciated the few fat pitches with pitchers and catchers reporting last week, so that was a good, maybe unintentional baseball reference of springtime is now here as we get out of the snowmageddon. But we appreciate you all listening. We're going to have conversations throughout this first half of the year. This is really the chassis of the work that we do on the investment structure, but we've also really built out a robust portfolio based off of your individual needs. So we have some clients that need the tech, and not necessarily tech, but individual stock exposure. And we need clients that want cash management. We want some that want dividends. Every strategy is unique to what you individually need. And so as advisors and partners with you, we'll work to determine what's the best fit, but just know this is the construct of the work behind the investments that we put in place for you. And we'll continue to review those. We'll have conversations, and then we also will likely have a couple of just economic updates and tax efficiency updates this spring that you should be looking forward to. And as always, don't hesitate to reach out to any of us if you have questions on this. We're open book, and we really greatly appreciate your partnership. Thank you so much.
Thank you.